Welcome to the Financial Freedom Blueprint. In this video, you'll learn exactly where your next dollar should go to build wealth faster and with less stress. We'll replace guesswork and random apps with a proven step-by-step system that manages risk and maximizes tax advantages. Let's begin. Here's the promise. By the end, you'll know a precise order for allocating your money each month. This method protects you from common pitfalls, prioritizes guaranteed returns, and captures valuable tax benefits. First, we'll quickly cover a disclaimer so you can apply the blueprint responsibly, and then we'll move into the agenda. This video is for educational purposes only and does not constitute financial, legal, or tax advice. Your situation, risk tolerance, employer benefits, state taxes, and timelines may differ. Always confirm current IRS limits and rules, and consult a licensed professional before making decisions. With that said, let's transition to today's agenda. We will start with the controversial truth about high-interest debt and how it compares to investing. Next, we will cover the strategic order of operations, then learn how to build and automate an emergency fund. After that, we will explore why tax-advantaged accounts are so powerful and clarify Roth versus traditional. We will bring it together with a case study and finish with pro tips and quick quizzes to reinforce your understanding. Let's begin with the key truth about debt. The key principle: high-interest debt, typically around 7 to 8% APR or higher, is extremely destructive to wealth building. Paying off an 8% debt is comparable to earning a guaranteed 8% return, which is hard to beat when markets are uncertain. However, there is a crucial nuance in the blueprint. After building an emergency fund, you capture your employer match before tackling high-interest debt, because the employer match is effectively free money and can exceed the cost of the debt. With this context, let's move to the overall order of operations so you can see how it all fits together. Here is the established sequence. First, build an emergency fund targeting 3 to 6 months of essential expenses to protect against unexpected events. Second, contribute to your employer's retirement plan just enough to capture the full company match. Third, aggressively pay down all high-interest debt, roughly 7% APR or higher. Fourth, maximize tax-advantaged accounts. If available, prioritize the health savings account for its unique tax benefits and then fully fund a Roth IRA. Fifth, increase contributions beyond the match into your employer plan with the goal of hitting the annual maximum. Finally, once all prior steps are optimized, invest any additional funds in a taxable brokerage account. Next, let's detail how to build that emergency fund quickly and reliably. Decide how much you need by estimating 3 to 6 months of essential expenses. If the full amount feels daunting, begin with a starter emergency fund, often $1,000 to $2,500, to cover immediate surprises. Automate transfers from your paycheck or checking account to a high-yield savings account so you do not rely on willpower. Keep the fund liquid and separate. Do not invest emergency money in volatile assets. If you tap the fund for a true emergency, prioritize replenishing it before advancing to later steps. With your safety net in place, we can focus on picking the right accounts. This table compares common account types without citing specific limits, which change periodically. Employer plans can be pre-tax or Roth and are valuable for their match and high contribution caps. Health savings accounts, available only with eligible high-deductible health plans, offer a rare triple tax advantage. Roth IRAs are funded with after-tax dollars and provide tax-free growth and withdrawals in retirement. Traditional IRAs offer potential tax deductions now, with taxes due later. Taxable brokerage accounts provide flexibility, but lack the tax benefits of the other accounts. Next, let's zoom in on Roth versus traditional to clarify which may fit you best. Roth IRAs are funded with after-tax dollars, and qualified withdrawals in retirement are tax-free. They are often advantageous if you expect to be in a higher tax bracket later in your career. Roth contributions, not earnings, can generally be withdrawn subject to rules, which adds flexibility. Traditional IRAs may provide a current year tax deduction and reduce taxable income today, which can be helpful if you need immediate tax relief. However, withdrawals are taxed later, and required minimum distributions apply. Your choice depends on your current versus expected future tax rates and your need for flexibility. Now, let's highlight the unique power of the health savings account. Health savings accounts are uniquely powerful. Contributions can be tax-deductible, the growth is tax-deferred, and withdrawals for qualified medical expenses are tax-free. If you can cover current medical costs from cash flow and invest HSA contributions, the account can grow like a stealth retirement account. After age 65, non-medical HSA withdrawals are allowed without penalty but are taxed as ordinary income, similar to traditional retirement accounts. Because of this triple benefit, the blueprint prioritizes the HSA ahead of the Roth IRA when available.
Next, let's visualize your entire journey as a simple roadmap.
This timeline shows the progression from the initial emergency fund to capturing the employer match, then eliminating high-interest debt, and subsequently maximizing tax-advantaged accounts. After that, it illustrates increasing employer plan contributions to the annual maximum, and finally investing any overflow in a taxable brokerage account. Keeping the emergency fund intact remains an ongoing priority. Now, to reinforce routing your paycheck, we will add a sequence diagram of how dollars should flow each pay period. This sequence diagram maps each paycheck to its destinations in order of priority. First, a portion goes to the high-yield savings account to build or maintain the emergency fund. Concurrently, contributions go to the employer plan up to the match. If high-interest debt is present, additional dollars flow to debt payoff next. Once the match is captured and high-interest debt is cleared,
contributions move to the HSA, then the Roth IRA, and then back to the employer plan toward the annual maximum. Finally, any excess goes to the taxable brokerage account. Conditional guards indicate that if the emergency fund is below target, savings should be prioritized before escalating contributions elsewhere.
This mind map summarizes the allocation philosophy. First, direct dollars to safety via the emergency fund. Next, capture free money through the employer match. Then, eliminate high-interest debts above roughly 7%. After that, emphasize tax shields, HSA, and Roth IRA, before turning back to your employer plan to reach the annual maximum. Only after these priorities are fully met should you direct overflow into a taxable brokerage account.
Now let's test your understanding with a quick quiz.
Question: after building your emergency fund, what should you do next according to the blueprint? Options are: A. Pay off all high-interest debt first. B. Contribute to your employer plan just enough to get the full match. C. Max out your Roth IRA immediately. D. Start investing in a taxable brokerage account. You may pause the video now to think about the answer. We will discuss the correct answer in the next section. The correct answer is B. After the emergency fund, you should contribute to your employer plan just enough to capture the full match. This is effectively free compensation and typically provides an immediate and significant return.
Following that, the blueprint targets high-interest debt repayment.
Question: at roughly what interest rate does debt become a high-priority payoff before general investing? Options are: A. 3%, B. 5%, C. 7% or higher, D. Only 10% or higher.
You may pause the video now to think about the answer. We will discuss the correct answer in the next section.
The correct answer is C. Debt at roughly 7 to 8% APR or higher should be prioritized because eliminating it delivers a reliable, risk-free return that is difficult to match consistently in the market. Now let's apply the blueprint in a practical case study. Let's assume you have $500 of extra cash each month. You completed a small starter emergency fund, and you're still building toward the full 3 to 6 months target. Your employer matches 50% up to 4% of your salary, and you carry an 18% credit card balance. The plan would be: first, direct enough to the emergency fund each month to reach the full target. Second, contribute to the 401k just enough to capture the entire employer match. Third, allocate all remaining dollars to the 18% card until it is eliminated. After the high-interest debt is gone, proceed to maximize the HSA, then fully fund the Roth IRA.
Next, increase 401k contributions toward the annual maximum.
Finally, when all tax shelters are utilized, direct any excess to a taxable brokerage account. Use the checklist to monitor your progress over time. Now, here are a few advanced tips to accelerate success. Automate your transfers and contributions so saving happens before spending. If possible and appropriate, refinance or consolidate high-interest debt to reduce your APR, but only if fees and behavior change make it genuinely beneficial. Avoid lifestyle creep by increasing contributions whenever you receive a raise. Use separate savings buckets to maintain clarity. Finally, review your plan annually, confirming contribution limits, account fees, and whether your asset allocation still matches your risk tolerance and time horizon. We're ready to wrap up with a quick summary. To summarize, Protect your plan by building an emergency fund. Then capture employer match contributions. Eliminate high-interest debt of roughly 7% or higher to secure strong, low-risk returns. Next, maximize tax-advantaged accounts, starting with the HSA where eligible, then the Roth IRA. And finally, increase your employer plan contributions toward the annual maximum. Only after these steps should you invest in a taxable brokerage account. Review your plan regularly and automate contributions to ensure consistency. Finally, a quick thank you and a call to action. Thank you for watching. If this blueprint clarified where your next dollar should go, please like the video, share it with someone who needs a plan, and subscribe for more actionable guides. Tell us in the comments where you are in the sequence: emergency fund, match, debt, HSA, or Roth, and what your next step will be.